18 seconds to go. We start a brand new week. It's a truncated week, but it's an important week considering that the market template is now favoring the bulls. The bulls have a spring in their stride. Global cues are stable. The FI's activity has been on the long side rather than on the short side. And when you typically see a setup like this where everyone is feeling left out, you will see a bout of short covering followed by a big bounce. First rates, any second on your screen now, the big screen will do all the talking. The first rates are, there is a shade of green, not like a decisive gap up start. Tata Motors is on a roll. One dispatch number has changed the outlook for Tata Motors. 452 rupees for Tata Motors, 14 rupees higher. You've got Tata Teleservices, which is moving up on strong volumes. You've got actually a lot of mid-cap stocks today, or I would say the real small penny stocks and the trader patronized stocks are off to a good start. TTML, Brightcom, Future Consumer, Suzlon. There is, I think, a block deal in 361. That's the new business arm of IFL. And then there is definitely constructive price action in Adani Power along with Ankita Cotton. I have no idea which company is this. But yes, Ankita Cotton is the other one. Ambika Cotton? Maybe. Yeah. Ambika Cotton, yeah, that's the other one. 63 and a half rupees for that. So yeah, look at the price action there, more than the volume. More than the price action, volume action is there.
Okay, a couple of other names which are going to be an active mover in today's trading session. RVNL, Shobha, Credit Access, strong dispersal numbers for Credit Access. Their AUMs have risen about 26.7%. The average ticket size as well has gone higher by almost about 12.5%. So that's, of course, a stock in focus. Record best ever quarterly sales in Q4 is what Shobha has clocked. Their sales values have come in higher by 26% for Godrej Properties as well. A sales volume uptick of about 19% on a sequential basis is what they've seen. MGL, IGL, after the new pricing mechanism for APM gas was announced. Let's see what both these stocks are up to. MGL holding up by about almost 0.5%, similar as the price action for IGL. Let's also see what ONGC and Oil India are up to, whether they're seeing any downtick on account of this new pricing mechanism. ONGC still holding higher by 1.25%. Oil India, though, downwards of 0.5% as we speak right now. Adani Wilmar, even their Q4 update has come in, and the Q4 edible oil volumes were flat on a year-on-year basis. Overall revenue also managed to decline in high single digits, but the stock is holding up by about almost 2% as we speak, intriguing as it may be. Let me just refresh my screens and tell you which have been some of the active movers. Tata Motors sitting right up there, 6% higher. Godrej Properties higher by 5.5%. Titan also seeing an uptick. Adani Enterprises, Indiabulls Housing, these are all your big movers. But Kunal, Tata Motors, the clear star.
Well, yeah, Aisha, I think that stock should tend to outperform even going forward. I think the bigger breakout has not yet happened for Tata Motors, so would continue to have a strong bullish stance from the on the stock from the auto pack. The stock which I would look to recommend as well as trade in the first opening hours is the real estate pack. It's a DLF. I think it's the chart which is now given a confirmation of a breakout above the 200 DMA price volume breakouts as well. So that's a stock which I'll be very bullish on.
अरे भाई टाटा मोटर्स इज अप, इट्स योर लार्जेस्ट इन्वेस्टमेंट. थोड़ा गर्मी होना चाहिए आवाज में.
गर्मी ऑलरेडी माहौल में है.
Naresh, what's making you happy today? Which is one portfolio stock of yours which is doing rock and roll?
Not many as such, but overall the stock I am watching out for is a contra buy on BHEL. The stock has done nothing, but I started recovering from the recent lows. So keeping a stop loss at 68, expecting a move towards 80 in the short term.
It doesn't matter it's a bull market or a bear market. Sameer Arora always has a Punjabi tadka in his voice every time when we interact with him. Right, sir? Good morning.
Absolutely.
Okay.
And why not?
Sorry?
Why not? And why not?
Of course.
Punjabiness.
Of course. So, looks like the worst is behind us, at least in the interim. Flows have stabilized. RBI has not increased rates. The valuation concerns are also getting addressed. Is it advantage bulls now for rest of the year?
I've been saying that for some time now, and at least for this year, that I expect this year to be positive and double-digit positive. And some of it got delayed a little bit because I was expecting the US to have settled down when I was saying this end of last year, and that has got delayed a little bit. But broadly, you are absolutely right that the worst is over and things are stabilizing. And India is, even though in performance wise, has done badly, we can say, but and that is related to China and others. But every day, if you see books, if you see discussions, if you see uh, Twitter, if you see economist cover, everywhere this issue of China versus US is heating up. And that has a big influence on big picture flows into China and corporates going into China and everything associated with it. And India is a beneficiary on that big picture theme for, it'll be a beneficiary for I think many years, but on the margin, a big deal for India.
Samir, so can we assume that the local crisis, which was largely because of Adani and trade deficit, that's behind us, and global crisis, which was largely because of inflation and US regional banks, that's also over?
I would think out of these, what is happening to the US banks in theory, I don't think is over. We are hoping that the system can handle it because, the actual losses in terms of mark to market losses and what percentage they are of US banks and particularly smaller banks and regional banks, that number may be quite high, which basically means that the system has to remain in stable conditions so that there is no panic triggered by these things. I think that is one angle on which I don't have a strong handle as to how to do it beyond just being a strong, that means for the Federal Reserve or for the FDIC and others to be signaling that they are anyway there for any bank that needs their help. Other things I think are over or getting
over. Samir, for the longest time, you've maintained that you've not liked IT, and that call has worked like a charm for you. But after the bout of recent underperformance, is it time to think contra now?
So far, I'm thinking that I will be able to handle any pain if IT does well immediately, because it's not likely to do very well. It might go up in line with the rest of the market in case I don't mind. But right now, I would not think that why I should step in immediately. First, let's see the guidance of Infosys. TCS, I guess, will not give any guidance. But if you read, like today or yesterday, it came that one of these companies is not honoring commitments to staff freshers. I think that is as bad as it can get. Now you may say, therefore buy when things are bad, but as you separately see, our Indian system doesn't accept openly that there is a slowdown. They say we will be beneficiaries of cost cutting plans, and companies will consolidate and stuff like that, and IT is the key thing. Let them accept it, let them say it in a few quarterly calls and all that, and then we'll see. Right now, I am not thinking that it'll underperform a lot. I am thinking that it won't pain me a lot if I don't have it, so I'll just stay out.
Samir, let's understand the case now. If I look at the markets in terms of commodity consumers versus commodity producers, last 1 year was all about high inflation, impact on margins, decline for commodity consumers. Is the reverse trade at play now for next couple of quarters?
I don't think that reverse play, at least we are not playing that, which would mean that these consumer companies that had very high valuations and which were hit by both high valuations and lower margins because of commodity and all that. Right now, the thing is the slowdown is still there, but more than that, this phase where the market does not like very high valuations for companies that are growing below market, normal market, which means they are growing 8, 10, 12% per annum and expecting that they should get multiples of 40 and 50 on earnings. And people can keep saying, no, you should not look at earnings, you should look at some other nonsensical number. But the point is, in the end, earnings takes care of many of these things for such companies, which anyway converted a lot of their earnings to cash with or without anybody analyzing it. So the thumb rules work in most of these long held companies or long valued, who've been around for long. that the valuations are out of line. So, and also the slowdown of the consumer has not gone away. So it will benefit, but the reverse trade we are not playing yet.
So if somebody has to invest the Samir Arora way, will it be all the way again buy into urban consumption, buy into banks? Because that's been the Samir Arora way for last 12 to 18 months. Names like Manyavar or Campus.
No, actually, that is not my way. My way is that I buy 20 to 25 companies in the second group where I'm buying them a little early or sometimes when they might be expensive in somebody's view. But overall, I'm playing with 20 to 25 companies along these three themes, of which today I don't have one theme, which is IT. But otherwise, the three themes are financials, consumer, and IT generally. And then you let the market decide or these companies decide how they evolve over time. It's not to say on any one name that this is the name we have found, but in the group of 25 names, mostly enough outperform to make the whole portfolio outperform. So play it like that instead of committing to any one name, both your money and your ego beyond a point.
So that's the strategy that you're adopting. But let's also understand your view. I know we always have spoken about this, but maybe you want to revisit some other new age tech names in the portfolio now, given the kind of strategy that these companies are adopting. Do you think that this space deserves a relook?
Yeah, so we have two names in these 25 names, which are Paytm and Zomato. Paytm, of course, we have got good timing, so we are up some 20-25%. Zomato, we were up and then it went back, so now we are zero. But both these are big brands, big survivors. And although, like for example, you read recently that Reliance is coming into cosmetics or trying to compete with Nykaa and stuff like that. Nobody is going to announce, new person is going to say that we are going into food delivery or going into even payment business so easily. And therefore, these guys are now in a place where previously there may have been 20 guys and now they are, in the case of food delivery, down to 2. And there is no way a third guy can come in. And in this, one of the two is unlisted. And if they compete too hard and think that by getting a few more market share points here or there, they can have a hope of getting listed. That also does not work unless Zomato does well. So I think that the steady state solution will be that Swiggy will back off, let the Zomato win a little bit in the market so that some years or months later, maybe 1 year later, it can hope to go public. Otherwise, it can keep fighting without having ability to get listed, because the market will not accept a second name in exactly the same business with nearly exactly the same market share, with nearly exactly the same number of riders, with nearly exactly the same number of restaurant partners, and the first guy not doing well. It is just big picture in this case. But beyond that, it's an optionality, because the second business, which is Blinkit, also seems to be progressing well, and over time that would be worth a little bit on its own. Plus, both these guys, that is Zomato and Paytm, have $1 billion cash kind of thing. So it's okay for now. It's both are optionality businesses, and so far so good.
You realize that Samir also saw the ad in which we have Nayantara
Yes.
and
Yes.
yeah, one of the
Nayantara's-
models. He's calling it Zomato, not
I saw
Zomato.
Oh, did she send it? It's so true. It's one of those brands जो घर घर का brand बन चुका है. It's just that you don't
Still
know how.
mispronounced.
That is what it happens.
Zomato है कि Zomato है.
So Samir,
Right, Samir?
was it Zomato or Zomato?
I go with Zomato.
Zomato, yeah.
Typically, when interest rates peak out, growth stocks, they make a comeback. Would you buy into this good old valuation argument that interest rates comes down, while growth stocks, they start moving higher, and value stocks, they start coming down?
So that is what I was saying, that normally that would have been the case, but the valuations of these so-called very high valuation companies which are growth rates are not very high, mostly these consumer companies which used to all their life, when I remember investing in them, which was not very long ago, maybe 5 years ago, and for its previous 10-20 years, would trade in the multiples of 30s and maybe sometimes reach 35, 38, 40 multiple on earnings. And this cash business that no, you should look at cash, all these guys who got 35, 40 multiple were anyway very good at converting to cash their earnings, and that's why they got these multiples. Otherwise, they were always a Tata Steel and something else available at 5p. So that everybody in the market understood 10 years ago also. Till this story was a bit oversold by saying that if you convert something to cash, don't look at P. And these P's became 50 and 60. And in the meantime, the earnings growth of these companies came to GDP in nominal terms and lower because of maybe a little bit higher penetration already and therefore a little bit of saturation. And mostly then because there is so much new entrants in these businesses, and also people's preference for what they want to spend money on change, because now they want to buy a mobile phone and things like that, which then has to substitute for something else. So therefore we are not buying these high P but not high growth, just 10-12% earnings growth, and saying that it is stable, so let me give 40-50 P. That's what I was saying in the beginning.
I was just scanning through data, and there are a lot of historical correlations which have not worked this time. Correlation number 1, weakness in dollar index and strength in commodities. That has not worked. Correlation number 2, in the first hike of an interest rate cycle, equity markets, they always do well. That has not happened. Why some of these historical correlations have been broken?
For the second one is that because I'm assuming you're talking from the US point of view, which might have influenced us, is because this time the difference in terms of how much was the targeted inflation and how much inflation had reached was so high. I think it was the biggest that I've seen in 25 years. And the language of the Federal Reserve and the commitment that they had, and of course this has been the biggest hike ever. So maybe the market anticipated that it is not just one hike and therefore after 2 hikes things will be okay. It was clear that there will be 10-12 hikes if it was counted in terms of 0.25%. And they have been very big hikes. So maybe the people looked beyond the first hikes and stuff like that.
And on the first correlation, weakness in dollar index is always strength in commodities. That also has not played out this time?
That may have to do more with China. Actually, the reason why I have not been bullish on commodities, although generally I'm not bullish, but every time you need some angle, is that this time the market, I think, wrongly perceived that China opening is a commodity positive trade, because this time China opening was more a consumer related issue, that these guys have not been able to travel and they were locked in their cities, so they didn't go to the local Starbucks and stuff like that, rather than that some projects were stuck. And when the zero COVID policy was removed, that suddenly all those projects that were stuck or the investments that had to be made could now be made. I don't see from where people got a positive commodity cycle connected to opening up of China, which I thought was more consumer related opening in this round. But I don't know exactly in which phase you're talking. Generally, anyway, I don't like commodities, so I find all excuses I can to argue against it.
Right, Samir, always good chatting with you and always good having you on the show. Let you go on that note. Let's just refresh our rates and tell you where the markets are settling in at. Still pretty quiet. And yes, the headline number is impressive. We're holding at 17,650 plus levels as we speak right now. The breadth pretty much even, Steven. Tata Motors holding up. Idea and Bharat Forge are not. RBL Bank is not. Asian Paints as well as the laggard. So is ICICI Pru Life. But good quarterly updates from Godrej Properties. That stock holding out very smartly. Titan up 2% right now. And MGL is your big star performer as well, holding up 3% as we speak. But let's talk with Vimal Kejriwal from KEC International and talk about the latest order wins. Vimal, great to have you today on ET Now. Thank you so much for taking the time out. You've won this new order for about 1,213 crore rupees, and we understand across segments, taking your total order inflow also to an all-time high. Which segments would you say are driving growth at this juncture and, contributing to your order inflows?
Asha, good morning. I think almost 90% of these orders have come from the T&D sector. Okay, and if you look at our year-end inflows for the year, it's around 22,000 and odd crores, which is 30% higher than last year. Almost 50% of the orders have come in from the T&D sector, and another 30% have come in from civil. So those are the two large sectors which are basically driving our order growth.
Profit margins, they remain constrained owing to the volatility in key raw material prices, as we understand, and especially for your international EPC contracts that are fixed price in nature. How's the margin profile been this quarter, and what's the outlook for the full year, if you could give us that?
So I'll not be able to talk about the quarter and this, but I'll tell you that the volatility has been there. Volatility is now subsiding. And what we have been talking about is that from Q2 onwards next year, not next year, now it's FY24 already, we will start seeing a good return to profitability. The volatility has come down, I'll say. Steel is now almost stable. And even if you look at aluminium, copper, they have been a little bit volatile, but within a band. So I think we are now getting comfortable with the supply chain volatility. And it has been baked into the new orders which we are winning in.
Okay, fair enough. Good morning, and just wanted to understand your margin outlook as well, because there was a weak performance of SAE TARs and that did impact your margin. So what is the outlook on the status of completion of orders in the SAE loss-making project?
So what we had said was that in Q3 last year, we will complete all our loss-making orders, and which we have done. And now we have a large order book in SAE, which is all only for supplies. So, we had lost money in some EPC orders. So for the time being, we had stopped taking EPC orders. Right now, I don't have the exact number, but we have roughly around 17 or 1800 crores of orders in SAE, both between Brazil and Mexico, and all are supply orders. And I think we do hope that they will make decent money. What we have also said earlier is that we will be turning operating positive in SAE, and we should hopefully be PBT positive because there's a large interest cost which we are trying to restructure and work out. So from Q2 or maybe hopefully Q3, definitely we will become PBT positive, in our SAE operations, including Brazil.
Talk us through what the outlook is on the overall margins in light of this. Where do you see them headed?
So margins will take some time, as I said. At least I think Q2 onwards, we should start normalizing. Q4 would be a perfectly normal quarter. So I think we expect that by the end, when we exit the year, we should be back to close to double-digit margins.
How much of your orders, in a sense, are legacy orders, where you actually will start enjoying the uptick now?
So basically, Nikunj, the legacy orders are a few of them, but some of them are stuck in your, if you remember the GIB issues and all that, so we are not able to execute them. So in terms of volume and all that, very, very little. And whatever is there, I think Q1 is the area is a time when we will close everything, which is why I said that from Q2 onwards, we will start seeing a significant uptick in our margins.
Okay, fair enough. I just wanted to also get a sense from you as to your foray into new projects that you're looking at: hydrocarbons, green hydrogen, solar. What has the order traction been like over here? How are you looking at the overall mix for these new projects?
So in the new areas, if you look at civil, we got 4 orders in data centers. So that's one thing which is happening. And we have got a few orders in hydrocarbon, but still restricted to infrastructure. We still don't have orders in process units, etc. We are still building the capability there. So I think it will take some time for us to get orders into process units, etc. Okay, oil and gas is doing well. As far as green hydrogen and others and solar are concerned, we got a large 500 megawatt order in solar, I think a quarter back. And we are tracking other solar opportunities. And definitely we see some order inflows, and I'll say reasonable order inflows happening on the solar side in the coming quarters. Green hydrogen, I think the orders are still too small and too little. We are tracking them. We are working with some electrolyzer manufacturers, etc. But I think honestly, it's still far away that it will make a dent in the numbers.
Mr. Kejriwal, great to have you today on 18 Hour. Thank you so much for taking the time out and joining in.
Pleasure. Thank you.
That's the update coming in on whether, what a healthy and robust order book KEC International has right now. We're going to take a very quick break on that note with news that the Nifty is holding flat but in good stead. 17,674 a print in the Nifty futures is not going to give you reason to complain. And the market breadth as well has picked up just that wee bit. I can see newer names like PFC, Oberoi Realty as well join in the list of winners. We'll take a very quick break, come right back for more.
Markets, let's talk commodities and let's talk cricket. Peter McGuire joins us now, and
Peter's
hello.
here for the IPL.
It's not AI version of you, right? It's real Peter McGuire
It's
who
the
is
real
in
one
studio.
in person.
Yeah. Studios.
So what are we starting with?
Well, I think it's an interesting time over Easter. We've seen dramatic moves, and we're worrying, as far as geopolitical fronts, the China-Taiwan situation, what's going on ongoing with Russia and crude. So I think that's going to be a very interesting quarter, how it plays out over the next, couple of months. The first quarter was electric, and I think this quarter is going to be equally volatile and exciting.
When you say volatile, what would it spell for crude, especially considering now OPEC is getting so active, cutting production? We've already seen a spiral up.
Yeah, that really shook the market last Sunday week, and I think it hit everyone with a 6. It was out of the field. It really surprised everyone. And that in turn, I think there's further upside. Many of the investment banks are saying 95 is achievable, maybe even 100. So I just want to see where we are over the next matter of weeks. If anything escalates as far as tensions geopolitically, we could put $15, $20 on very, very quickly. So yeah, there's a lot of exciting times across that trading complex.
OPEC is cutting because they're worried about demand.
Yeah.
Is that good news? Is that bad news?
Well, I don't know. I mean, when you think about demand, we're still at 100 million barrels approximately a day from a big picture perspective. Yes, you could see a softening as far as demand, but, China's still doing incredible numbers. The world is, I've only got to drive past Mumbai and I've been here 12 hours and it's just incredible. The construction here, the movement, the mobility. So, you can't kid yourself that there's not huge demand across the planet. And we've just got to see where that all plays out from an OPEC perspective. And it's going to be, again, very exciting for the complex.
What about the Chinese recovery? How does that impact commodity, particularly crude prices?
Well, it's been strong. I mean, they've come out of the blocks very quickly after Lunar New Year, and I think it really surprised everyone with those growth forecast numbers moving forward. So I think, from a demand picture, we're very strong demand for crude, strong for base metal, strong for really every commodity in the world. And I think there's been chronic underinvestment over the last decade, which is going to come home to roost, which will in turn, I think, make this decade a continuation of the super cycle across the commodity complex.
Peter, the concern, it's not a concern, but it's something which we've been debating and mulling over from last couple of days, is that historically what we've read is that weakness in the dollar index or weakness in dollar is strength in commodities.
Sure.
That interplay this time has failed. Why is that?
Well, the dollar's come under continued pressure to the downside. It was there was a point in time that it was only a couple of months back, when it hit that 114, everyone was saying, is it capable, the US dollar index, of hitting 120? It's now at 102. You've seen big moves across the yen, of course, pound, Aussie dollar, and naturally the euro. So we're at the end, some are saying, of the rates tightening cycle. Some of those other currencies are going to see a continuation of rate rises. Example, probably the ECB and the pound. So I'm thinking that the dollar will come under a little bit further downdraft. And again, where Jay Powell's rhetoric is and inflation numbers, everyone's sitting on the edge of their seat, seeing if there's going to be any surprise with the minutes and his rhetoric.
Precious metals, though, because out of all the commodity baskets,
Sure.
that's where you're seeing maximum returns.
Absolutely.
Gold is at it phenomenal.
Yeah, it's been incredible after the last couple of, 6 weeks or so. It's been whipsawing. It goes that 1810 back to 2000, down again and then up. And it's currently at about 2010. I had a look at 2020. So it's got plenty of upside, I think, and the demand picture as far as precious and silver, don't count that one out. again, central banks have been hoarding gold, buying like crazy, and I think that the retail sector's really on fire.
Peter, when Bitcoin went higher, everyone said it's an alternate.
Yeah.
It's an alternate to currency. And
Sure.
it worked very well.
Yeah.
An unknown entity suddenly had a combined market cap, crypto had a combined market cap of $3 trillion.
That's right.
When it came below 20,000, everyone said, look, currency, a technology cannot substitute a currency. Currency is the sovereign power which every government has.
Sure.
But right now, when the world is slightly shaky,
Yeah.
banks are puffy-duffy, gold is up, Bitcoin is giving it company. So what are we getting it wrong?
I think it was oversold, and I feel as though that the best days are ahead as far as crypto.
Really?
Oh yes, definitely. They're back at 28,000, and the overall momentum I think will be to the upside maybe later on this year. There's a lot of uncertainty. You've got different payment systems that banks are looking at as far as centralised digital and of course decentralised, and the other side is countries asking for payment of commodities or goods other than the petrodollar. So I think that there's going to be, again, a fractured mindset. It's going to be incredible how it plays out. And as an observer looking in, I think volatility again across crypto and currencies is going to be incredible.
Would you make Bitcoin 5% of your portfolio? Or maybe more?
Yeah, I think so. Yeah, it'd be pretty hard not to. You know, there's a lot of traders out there that are absolutely in love with it, and I think that that's a global phenomenon, and the young people are really across it, and older with money.
Yeah, and especially in the near term, I think one fallout of the SVB and the banking financial crisis has been also why you've seen that steep reaction in Bitcoin.
Absolutely. You know, 18,000 to 28,000. It's been a monstrous
a
move,
lot of
nearly up
money
50%.
moved out of those banks into Bitcoin.
We've forgotten a lot about that SVP. You know, it's only a month ago. I mean, you know, it shook the markets like anything, and now you're here just on Easter Monday and it's more or less forgotten about. So I don't necessarily think that that's been put to sleep yet.
You know,
How are you positioned in India? Do you have any exposure to Indian markets directly or indirectly?
Well, I mean, what we do, we're offering, you know, retail derivatives globally, but as far as a personal side, I just think that there's just so much upside. I've been an advocate of India, and I'm not saying that because I'm here, but it's, you know, you only got to look at the dynamics. Incredibly young population, growing population, appetite, entrepreneurship, innovation. Some of the best professors in the world are Indian. I've been trained at US business schools, and you know the brains trust here is just immense. So I'm not doubting India's recovery or growth over this decade, let alone what will happen in the next matter of decades. So the best years, I think, for an economic growth are ahead for India, and you've only got to look at the construction here, the infrastructure, and everything is just coming up the curve at 1,000 miles an hour. It's boom time. It truly is. It's mind blowing.
speaking of boom time, would that be an adjective that you'd use to describe gold prices as well? Any particular levels that you'd be tracking, or has it pretty much run its course?
I don't think it's run its course. I think its best days are again ahead of it. And I think how it trades over the next 18 months is going to be electric. I wouldn't be surprised to see big whipsaws, and I won't be surprised to see it up from here considerably. I don't know what that number is going to be, but I think the overall momentum, central banks buying, geopolitical concerns, there's a lot of pluses playing into gold's picture and its basket.
Sounding very bullish to me. Bullish on crude, bullish on Bitcoin, bullish on India. What are you bearish on?
Well, in some ways, I'm saying, you see something like the Nasdaq at 16,000, then it's back to 10,000, now at 12,000. There's a lot of fear across Main Street as far as earnings season, how they're going to go as far as equities. I'm pretty sure that equities probably will have another leg up, but I just want to take my point in time to look where US trades in the next matter of months. Inflation worries me, and that's a concern that the world's trying to get its head around how that's going to play as far as equity market growth. We've got strong interest rates, and that flight to safety from money market versus equity. So yeah, I'm sitting here going, yep, just looking at it all and inhaling and being patient. I think you've got to be patient at the moment.
Yeah, absolutely. Peter, great to have you in the studios, and I'm guessing you must have already seen a couple of IPL matches by
Yeah,
now.
I have. Yeah, they've been incredible, and you know, it's just such a wonderful game, and yeah, I'm looking for as the season wears on, the excitement is really going to ramp up in the next couple of weeks.
Absolutely. Enjoy the rest of your stay.
Thank you.
Great to have you in the studios. Also, let's hear it out from Dr. Feridun Fishraki, the founder and chairman at FGE. He's pretty positive on the prospects of crude, and he's also quoted levels as high as $100 to a barrel.
Move was a great surprise, and OPEC must have thought that they are preventing something which may be happening in the next few months, and they wanted to preempt it by cutting the production early enough. So it took us all by surprise, and $100 easily achievable, and even more than that is possible.
Dr. Fishraki, how do you see the role of China reopening and economy coming back? Some say that it has actually been slightly on the softer side, the China reopen, versus what they had estimated earlier. So demand did not come back in the in a big fashion in China, and that is why OPEC actually took these steps to adjust the production. What are your thoughts on China demand?
Well, you know, the difference between China and India is that in China only one person decides everything. In India, 10,000 people have to decide everything. That's why things don't get done so easily. In China, based on what we understand today, we are still pretty bullish about the recovery. It may not be as great as everybody had hoped for, but it's still 600,000 to 800,000 barrels per day of demand growth. So most of the demand growth, both in COVID recovery and economic growth, is still we expect in China. So we remain quite bullish. Now, maybe the Saudis see some weakness at the end of the road in there and decided to preempt. But, for the first time last month, China imported more crude from Russia than India did, 1.4 million barrels per day. And Chinese also are exporting refined products based on the cheap Russian crude, substantial amount, more than 1 million barrels per day. So it is still not 100% clear that they will recover as quickly as we all hope for, but the signs are very positive.
You know, coming back to the main hypothesis which you had, that possibility of $100, how much probability would you assign to that, and what kind of time frame, given the way economic data is coming, demand trends, running inventory, all of that? Are we talking about a 6 months kind of a window where $100 prices edging towards that is possible, and how much probability would you assign to that?
I think probability is 90% or more. So when you do the balances, it's obvious that second half of this year would be very hard to contain. So when would it reach there? It would be third and fourth quarter, and definitely by early 2024, and may go higher than $100 too. So $100, $95 to $105 is our assumption.
That's a very big takeaway coming in, Dr. Fishraki. Thank you so much for joining us on the show today. Dr. Fishraki is a global authority on energy. Everybody listens to, actually is making a case by third or fourth quarter of this year or early next year, we should be ready for $95 to $100 base, but the window is also open for higher prices from there. China recovery has been strong, and the dynamics are actually favoring and that the higher prices, and that is the reason OPEC came.
Okay, that's the view coming in, all-round outlook on crude oil prices and commodities. That's the index at 17,650. Not bad when it comes to the mid-cap index as well, but banks are a little bit quiet in today's trading session. In fact, some of the heavyweights like an IndusInd Bank are feeling the heat. Just check in on the charts there. You've also got a Bajaj Finance, HDFC Bank along with Axis Bank. That's a bit quiet, while ITC and Reliance Industries are doing precious little. Tata Motors, on the other hand, it's a whole different story. It continues to remain in top gear, and then support coming in from heavyweights like Wipro, TCS, L&T, as well as M&M. Let's move right on then and put the spotlight on Ujjivan Small Finance Bank. What's driving their disbursement growth? Where is demand peaking? And what's the roadmap for the next few years? Itara Davis is the MD and CEO at Ujjivan Small Finance Bank and now joins us on the show. Thanks so much for taking time out. Given that we did see the Reserve Bank in that surprise move actually holding interest rates, what's your view in regard to this rate pause? Will this be the terminal rate? And what is your sense in terms of the impact on individuals like customers from a loan demand perspective and otherwise?
Yeah, I think although the market was expecting a 25 basis points hike from the RBI, it's good that RBI has held the rates, because I think it's better to watch and see what is the outcome of the current situation. Conflicting reports are coming from the market in terms of economic activity, and sometimes it's better to wait for a while and then take a final decision. So I think holding it is good for the market. There's been a big scramble for deposits in the last quarter, especially during March, which is the end of the financial year. And that would have extended into the new quarter, into the new year, if we had seen a hike in interest rates. So that hopefully will be tempered a little bit. Now, in terms of demand, which was your second question, loan demand, the economic activity is still there. So we are seeing demand from some quarters, especially our business, is still seeing some demand. Maybe, with if the interest rates go up further, we may have some resistance. But at this point in time, the loan demand is still fairly good.
Right. So coming to your loan growth, it's a seasonally strong quarter and you've managed to match the Q4 FY22 growth of 10% sequential. Talk to us about where the demand is coming in from, and also how is the diversification to non-micro lending going?
Yeah, I think the demand for us is coming from all quarters. We are trying to improve the level of our secured book. And in the fourth quarter, we have seen good demand from housing. Our affordable housing has also done very well. So I think, the demand for loans we are seeing from all quarters. Although the micro banking was very good, the standout for the fourth quarter is affordable housing.
So on the diversification with regard to the new businesses, how do you expect progress on that? And by the end of 2024, what will be the mix?
Yeah, all the new businesses, which are essentially secured loan businesses, have started off, some in a very small way. But we see all of that picking up during the new financial year, 23-24. And, by the end of the year, they will be providing a few percentage points to the overall numbers, so that we will see a slight shift in our product mix. The portfolio will look more like only about 65 to 67% micro banking, and the rest of it will be a secured portfolio. So as we move forward, a more balanced portfolio is what we are looking at in the days ahead.
Your deposits as well have seen a sharp uptick. So where are these deposits coming from? Is it fresh customer acquisitions? And is the growth on the deposit side, according to you, sustainable?
Yeah, I think that's a very good point. Our deposit base has grown much faster than even the loan growth this year. And that is commendable given the way in which interest rates and the market is looking for deposits. This has been an all-round. We have had several new customers coming on board. There are certain target markets that we are concentrating on. All of those have done very well. Going into the new year, we are already seeing a fair level of liquidity, which will help us, set the tone and set the pace for this year. And we believe that our strategy is quite sustainable. We are opening 100 new branches this year. And, even the 50-odd branches that we opened during the last financial year have all aided this growth. In addition to this, we are pushing ahead with our digital strategy, which is, again, going to help us to build a good deposit base.
Right. You've also held, onto a 9% plus margin level. As deposits go up, where is it that you expect the margins to go?
Yeah, I think, the higher interest rates will hold out for a little longer. We may not start seeing the downturn. Definitely not until the later part of the second half of this financial year. So during the first half, we will be able to maybe sustain the net interest margins around the levels of the fourth quarter. And once those are announced in a few weeks' time, that will be known. But we should be able to maintain ourselves around the fourth quarter levels. And hopefully into the second half, when interest rates begin to show a downward trend, the margins will begin to come in our favor.
Fair point, but talk to us about the risk. Where do you see risk? What kind of credit cost you're looking at in terms of the new book?
Yeah, the collection numbers which we have also announced, and also the NPA collections has been very good. And our objective is to make sure that our 0 to 12 buckets are very well looked after. Collections there are being addressed, and then sustain on those levels. So I think, in fact, the COVID conditions have sort of gone away. We are coming back to more normal conditions, and everything revolves around the economic activity. As long as the economic activity can be sustained, I see that the NPAs and the PAR will be maintained, and we can bring it down towards the pre-COVID levels. And that's really our objective, getting it back to pre-COVID levels.
And the bank is growing at a good clip. If we were to ask you where your key metrics would stand by December, when the current term ends, do you think that you could tell us where you want to see Ujjivan over the next couple of years?
Yeah, the bank is growing at a good pace, as you rightly said. We have a flight path which we are following, and I think we are well in the right track. We will be able to keep the growth levels going forward, and also, as I said, diversify the portfolio. That, of course, will mean some adjustment in our product mix, and in the short run may have some impact on NIM. But in the long run, I think we have a sustainable model. And after the reverse, we are right now in the final process of the reverse merger. Once that is completed later this year, I think we will be able to look at other ways of growth as well. And I think that is something that will help us to move forward.
10:30.
Right. So you're currently guiding for for the merger to close by the end of this calendar year. Any chance of it closing earlier? Could you give us a timeline?
Well, all the documents have been submitted to the NCLT. So, as and when NCLT comes back to us for various things to be concluded, we will work with that. But, we are expecting this to happen or completed during the third quarter of this financial year. And, I think that target should be achievable.
All right, thanks for running us through your targets as well as where you see the business and how things are shaping up at Ujjivan Small Finance. Let's move right on then and focus in on India's AC makers, because clearly they've made price cuts a part of their strategy this summer. What's the quantum of the price cuts? What's the rationale behind this move? Vinny, who tracks the sector closely, joins in to put this all into perspective. Vinny.
Absolutely. Just when you talk about price cuts coming in, last summer we had not seen any price cuts. Before that also, there were no price cuts that we've seen in the summer season coming in from these AC makers, because there was a high and sharp increase in terms of the commodity price inflation. Now, despite the commentary that we've seen coming in from industry participants, on an average, what we're seeing in the industry is that the prices actually have seemed to come down marginally. This summer, we're talking about calendar 2023 summer, and overall, no price increases have been taken by the AC makers in the industry in this summer versus the last year. Talking about specific players, let's talk about Voltas and its peers. Now, Voltas actually seems to have taken a significant price cut this time around. Mainly, this is to match the prices that are offered by Havells Lloyd, the Lloyd segment for Havells, which makes the ACs. So, yes, they are trying to match those prices of Lloyd's, as well as, this could maybe have a slight bit of a potential impact in terms of the margins, but that pricing gap. Voltas is trying to create a pricing gap versus peers like Daikin, Hitachi, LG as well. And previously, when you look at it in calendar year 18 and 19, there was a sharp pricing gap between Voltas and its peers of around 3,000 to 5,000 rupees. Then last calendar year 2022 summer, there was no pricing gap. And again, this time around, there is a pricing gap of around 2,500 rupees of Voltas versus its peers as well. Even LG has actually seemed to have reduced prices by 3%. Samsung too has reduced prices and reduced its competitive intensity and taken some bit of a price cut as well. So overall, Credit Suisse is maintaining a cautious rating on Voltas and an outperform rating on Havells. So keep an eye out on the AC industry.
Yes, we sure will. Let's also find out from Vamakshi what the Q4 update for Godrej Properties is like. This stock, of course, has been one big buzzer from the word go today after its Q4 updates. And of course, how the performance has been from Motilal Oswal as well, Vamakshi.
Well, it's looking like a good update that has come in from Godrej Properties. The company has achieved its highest ever annual as well as quarterly sales. Annual booking, in fact, is 22% ahead of its full year guidance. The sales volume has grown by nearly 40% in FY23 as well. So overall, it's looking like quite a robust performance as far as sales is concerned. And this in turn has translated into record collections, with cash collections growing by nearly 41% in FY23 to 8,991 crores. Apart from that, it has also been a best ever year for the company in terms of business development, with additions nearly doubling over what the company had initially guided. Motilal Oswal has also come out with a note on Godrej Properties. They believe that the company's market share has expanded to 8% from calendar year 22 from around 2% seen in calendar year 16. Now, after 2 subdued years, business development has finally picked up pace in FY23, and this is expected to continue in FY24 as well. Interest rates are no longer appearing to be a dampener, and in fact, they're expecting the overall industry volumes to grow at nearly 5 to 10%. Now, as far as Godrej Properties is concerned, they're targeting a pre-sales CAGR of nearly 20% from FY23 to 26, and in 26, they're expecting to clock in sales of nearly 20,000 crores. Now, what the management believes is that if the launches are happening as per plan, they in fact plan to achieve this target a year in advance, that is in FY25 itself. The company also remains on track to deliver improved profitability, and the management is confident of expecting a PAT margin between 10 to 15%. So overall, given all these factors, Motilal Oswal has upgraded its rating on Godrej Properties to a buy, given a target price of 1,575 per share, which actually implies an upside potential of 40%.
All right, that's the latest coming in with respect to Godrej Properties. The Motilal Oswal view saying that it's a buy rating, a target price 1575. Let's move on then. Tata Motors as well. What a mover in today's trading session after it shares very upbeat updates for the JLR arm. They've also said that there's been improving semiconductor issues, which has aided their overall sales. Let's take it across to Sharad, who joins in with the details. Sharad?
Well, yes, on an intraday basis, Tata Motors, you see, has seen a biggest jump seen in almost 11 months. And of course, the fourth quarter operational updates have been coming in. The wholesale numbers as well as the retail numbers have grown between 24 to 30% on a year-on-year basis. And yes, the commentary is right, especially when the chip supply is expected to recover going ahead. And the order is coming in at almost 2 lakh units, which is also a good sense of client demand coming in, especially for their Range Rover products. And apart from this, also the free cash flow, that number is a very important announcement coming in from the company of almost $800 million of positive inflows expected for the quarter, and for the year it's almost 500 million pounds. Apart from this, also the global wholesales numbers also were pretty decent. Even the brokerages have given thumbs up. BofA has maintained a buy rating with a target price of 475 rupees per share, and they have stated 2 important criteria. First one being, of course, the volumes as well as the free cash flow generation. They have been positive side, and they have actually beat the analyst estimates. And also going ahead, the focus would be there on the deleveraging part as well, and there might be also a surprise kind of a growth coming in, especially for the booking run rate going ahead. Now, when it comes to Goldman Sachs, they have actually upgraded the stock now to buy from the neutral levels. Now, the target price is set at almost 550 rupees per share. with the valuations expected to come in at almost 7.4 times its P numbers for the FY25 estimates. And going ahead, they're expecting there'll be a strong volume growth in the JLR segment. And do remember, this contributes almost 70% of the total top line for Tata Motors. And also the EBITDA estimates are being lifted for FY24 and FY25 between 15 to 16%. And lastly, they have also stated that the market is actually underestimating JLR's EBIT margin potential.
Okay, thanks very much for giving us those details. That's Tata Motors in top gear. Time for Chartbusters then. We've got our chartists right back, Kunal Bothra as well as Naresh Mirani, to walk us through their top recommendations. And Kunal, we were discussing real estate pretty extensively this morning, and you've got your favorite within this space. What is it?
Yeah, so it's DLF, Avan. Very interesting charts for DLF, because when we look at this from a very short-term time scale, the stock has given a classical breakout. Now, this is a very short-term time frame charts for DLF. This starts from July 2022, when the stock started to get into a trading range. 340 approximately was the base of this range for the stock, and 400 to 420. These 2 points are the zones of resistance for DLF. Now, broadly in the last 9 months approximately, the stock has been into this 60 to 80 point trading band for itself. But the move on the short term charts is very intriguing. This is the move of consolidation for DLF, where the stock got into a very smaller kind of a trading range, 380 to 340. This was the minor trading range for DLF. The stock has given a confirmation of a breakout of 380 levels, which means that post the breakout, we could now expect at least a 420 as an immediate target for the stock. And once this 420 gets broken, we are talking of almost a 9 to 10 month consolidation pattern being broken out for DLF. So it's a stock which should be traded in stages. Initially, a target of close to 400 to 420 range, and then post the breakout of 420 levels, we could look at a possibility of a new high, 52-week high for DLF above 460 levels as well.
Okay, Kunal betting big on DLF. Naresh, BHEL on the cards for you?
So looking at a contra trade out here, the stock has a tendency to make big moves and correct quite a bit and retest the major zones. So if you look at the stock chart, the stock made a move from 45-50 levels all the way to 90. The last breakout for the stock was at 65-68, and now we have retested the same levels. And Friday was a big reversal candle. The last 2 day volumes are interesting. I would eventually expect it to break out above that 75-80 mark as well and go towards a new 52-week high. So that's a kind of trade where the risk reward looks very interesting at current levels. So would keep a stop loss at 68. I have a target price of 80 in the extreme short term and 100 plus in the medium term. So looks interesting from a risk reward perspective.
Right, stock strategies then. Kunal, what's on your list?
So betting again on Ultratech Cement from the large cap cement stocks as a breakout candidate. Buy with a target of 78.75 over the next couple of days. Stop loss at 7,600. And Tata Chemical has also given a breakout, trading very close to that 1,000 mark. So would suggest a buy 1,035 as a target. Stop loss at 975.
Okay, there you have it. That's the view coming in on from Kunal. What about you, Naresh? What are your top trades?
So a short-term breakout seen on FSL, First Solutions Limited. Good volumes on Friday and a follow-up today as well. Stop loss at 110 and a target price of 120. Second is a buy on L&T, maintain the positive stance. Good breakout done here. A stop loss at 22.50 and a target price of 2,500.
Okay, let's take a very quick break then on that note with news that Tata Motors is now scaling a peak of over 8%. That's the kind of gain that you're seeing on the stock. And Godrej Properties as well, 6.25% higher as we speak on the stock right now in trade. For the Nifty, we're nicely holding marginally in the green, just a little bit. 670,675 on the Nifty futures as we speak right now.
Let's talk gaming and let's understand that how essentially the new gaming laws are going to be changing things for the entire gaming sector per se. This is joins us now, founder and CEO with Nazara Technologies. This is good morning. Thank you for joining us. What's your understanding of the new legal framework provided by the new rules? I mean, will this change anything for investors, at least in the online gaming industry? Is the definition between skill and chance now really clearly outlined?
Yes, absolutely. I think what Mr. Rajiv Chandrasekhar released last week under MITI is actually a game-changing, policy for the industry. I think two things have happened, right? One is, the government has recognized gaming formally as an industry and started giving guidance around it on how it has to operate. And I think that's a long way that the industry has come over the 2 decades that at least Nazara has been in business. So I think we are very excited about that. The second thing is the skill-based real money gaming space, right, has been the most monetized segment of the industry. But it has been surrounded over the years with a lot of gray area and unclarity on what is legal, what is not legal, what is a game of skill, what is gambling, how is taxation to be applied, etc. And this has prevented at least companies like ourselves to very aggressively invest in these gray areas. I think that is very rapidly changing. And the regulatory clarity that we have been asking for since many years is very fast emerging. In this budget, you had clarity on online TDS, which has come through, including the recent amendments. You have MITI's gaming guidelines come through. I think the last cog in this wheel is the GST. And once that is also clear, I think the whole skill-based real money gaming space is ripe to take off. And Nazara is also going to make very aggressive moves in this space now that this clarity is emerging. So I think all around good news for the industry.
Speaking of GST, I just wanted to understand from you, because the online gaming rate is likely to remain at about 18% on gross gaming revenues. What would be the implications of this? Because that would be the same that it currently is, right?
Yeah, I think if that comes through, it will be the best news for the industry, right? But I think the more important news really is about the clarity emerging. It's dragged on for a long time. And now the sooner the GST part is also plugged in, I think you will have a holistic clarity on skill-based real money gaming in India. And that will allow for a lot of growth in this industry.
Skill-based real money gaming. And, I know we've asked you this time and again, but for your company, it's a very small component, right? So what is it that you would like to hear in terms of the clarity on this, and what would be the implications on your overall revenue pie on real money?
I think, like I just said, right, a lot of the clarity has emerged. The GST part is the final cog in the wheel. And from a Nazara perspective, we have been sitting on the fence. We have 5% of our revenues that come from skill-based real money gaming through open play that we run. But that's a fantastic consolidation vehicle. And as we've always stated, that as clarity emerges, we will very aggressively invest in this sector. And this will allow us for very fast scale up of revenues in the years to come. So I think at least at Nazara level, we are now very actively working on a larger blueprint for the real money gaming space. And you will surely hear, more exciting news from our end on this space in the coming months.
Nitesh, also wanted to understand, this 30% TDS on net winnings from online gaming in the user account. How does that impact you? And would it really move things?
Yeah, I mean, it doesn't again impact us much given our exposure to RMG today. But I think it's a short-term hiccup for users to get used to the new policy. I think the new policy is fairly fair. There was some ambiguity which these recent amendments kind of also clarified. So I think it's a path in the right direction because it was more important to get the clarity, and I think that clarity has been achieved.
Do you see after the clarity this entire skill-based gaming ecosystem becoming big? There was this great start, but then policy confusion. Post-policy clarity, enough and more do you think will normalize for this entire space?
Yes, I think you will see a large spurt in growth. You will see a lot more investor interest. And the good news is that, a lot of these guidelines and policies will also really help protect consumers, which is very important for the long-term sustainability of the business. And the last thing is that all the gray market operators, all the international betting companies, etc., who have been having a field day in India, operating without any restrictions, will face a lot of challenges operating further once these policies firmly come into place. Which also means that the share of the wallet that they were eating into of the consumers will get freed up for more responsible gaming companies to work towards and get better ARPUs.
Outlook, then just a quick word on your overall margins, because you've been saying that you're looking at expansion very aggressively. Is there anything on the cards right now, and where does that take your overall margin picture?
Yeah, we're right now on track to meet our margins as we have guided earlier for this year. And the company has grown very well. In the first 9 months, Nazara has grown 80% in revenues. So we're very happy with the balance of fast revenue growth, remaining profitable, and generating positive cash flows. I think that's the right way to approach. And FY24, we will continue to do that. We are seeing large opportunities in front of us, like we just spoke on the skill-based real money gaming, as well as the casual gaming side. So we're also looking at attractive acquisitions that we will do in this year in both these segments to scale our business as well as potentially our margins further.
The general view is that the startup funding has dried up. A lot of innovation in the gaming space will not really multiply or will not scale up. Indirectly, are you happy with that? Because that means existing company like yours who got cash on their books will be able to acquire and will be able to grow.
Yes, I mean, I think it's a fantastic opportunity for Nazara to, invest in the right founders and the right companies and acquire at a fair value, I would say, right? So clearly it is the current market sentiment is actually a very good opportunity for us. But I think even if you zoom out a bit, India is on a trajectory of growth on gaming, which is, these short-term turbulences of market sentiments and all may just pause it for a little time or slow it down for a little time. But I think the long-term growth, if you were to zoom out, let's say a 5-year view, right? I think you're on a very strong trajectory, which will eventually reach where India has a potential to become a gaming nation of the world.
5 years out, if you have to, let's say, talk about Nazara per se, how much of the forecasted growth will come because of the existing business, that is organic growth, and how much could come from inorganic growth? Because you've also been growing by acquiring.
Yes. If you look at our businesses over the last 3-4 years, every business that we have acquired thereafter has grown very well organically. So we are very clear about it that the real value creation does not happen through new acquisitions adding revenue, but those new acquisitions starting to deliver very strong organic growth. And we focus very much on those businesses. The way as we enter FY24, we see all our businesses having strong growth trajectories. So organic growth will continue to be very healthy. And we will also additionally acquire new businesses that can kick in faster and more organic growth in the years to come. So that's how we're thinking. I think a lot of our focus is on organic growth of existing businesses as well as new businesses that we acquire.
You go on that note. Thanks so much, Nitish, as always, for joining in and giving us a little more clarity as to what these moves could mean for the online gaming sector. That's 5:41 on Nazara Tech. All right, let's hear it out then from Samir Arora. We just spoke to him about his outlook on the markets, and he says that India is going to be a huge beneficiary of the global volatility. Here he is sharing his views on IT and even new age tech stocks. Listen in.
I expect this year to be positive and double-digit positive. And some of it got delayed a little bit because I was expecting the US to have settled down when I was saying this end of last year, and that has got delayed a little bit. But broadly, you are absolutely right that the worst is over and things are stabilizing. And India is, even though in performance-wise has done badly, we can say, but and that is related to China and others. But every day, if you see books, if you see discussions, if you see Twitter, if you see economists cover, everywhere this issue of China versus US is heating up, and that has a big influence on big picture flows into China and corporates going into China and everything associated with it. And India is a beneficiary on that big picture theme for, it'll be a beneficiary for I think many years, but on the margin a big deal for India.
Samir, so can we assume that the local crisis, which was largely because of Adani and trade deficit, that's behind us, and global crisis, which was largely because of inflation and US regional banks, that's also over?
I would think out of these, what is happening to the US banks in theory, I don't think is over. We are hoping that the system can handle it, because the actual losses in terms of mark-to-market losses and what percentage they are of US banks and particularly smaller banks and regional banks, that number may be quite high, which basically means that the system has to remain in stable condition so that there is no panic triggered by these things. I think that is one angle on which I don't have a strong handle as to how to do it beyond just being a strong, that means for the Federal Reserve or for the FDIC and others, to be signaling that they are anyway there for any bank that needs their help. Other things I think are over or getting over.
Samir, for the longest time you've maintained that you've not liked IT and that call has worked like a charm for you. But after the bout of recent underperformance, is it time to think contra now?
So far I'm thinking that I will be able to handle any pain if IT does well immediately, because it's not likely to do very well. It might go up in line with the rest of the market in case I don't mind. But right now I would not think that why I should step in immediately. First, let's see the guidance of Infosys. TCS, I guess, will not give any guidance. But if you read, like today or yesterday it came that one of these companies is not honoring commitments to staff freshers. I think that is as bad as it can get. Now you may say, therefore buy when things are bad. But as you separately see, our Indian system doesn't accept openly that there is a slowdown. They say we will be beneficiaries of cost cutting plans, and companies will consolidate and stuff like that, and IT is the key thing. Let them accept it, let them say it in a few quarterly calls and all that, and then we'll see. Right now I am not thinking that it'll underperform a lot. I am thinking that it won't pain me a lot if I don't have it, so I'll just stay out.
Samir, let's understand the case now. If I look at the markets in terms of commodity consumers versus commodity producers, last 1 year was all about high inflation, impact on margins, decline for commodity consumers. Is the reverse trade at play now for next couple of quarters?
I don't think that reverse play, at least we are not playing that, which would mean that these consumer companies that had very high valuations and which were hit by both high valuations and lower margins because of commodity and all that. Right now, the thing is the slowdown is still there, but more than that, this phase where the market does not like very high valuations for companies that are growing below market, normal market, which means they are growing 8, 10, 12% per annum and expecting that they should get multiples of 40 and 50 on earnings. And people can keep saying, no, you should not look at earnings, you should look at some other nonsensical number. But the point is, in the end, earnings takes care of many of these things for such companies which anyway converted a lot of their earnings to cash with or without anybody analyzing it. So the thumb rules work in most of these long held companies or long valued, who've been around for long, that the valuations are out of line. So, and also the slowdown of the consumer has not gone away. So it will benefit, but the reverse trade we are not playing yet.
So if somebody has to invest the Samir Arora way, will it be all the way again buy into urban consumption, buy into banks? Because that's been the Samir Arora way for last 12 to 18 months. Names like Manyavar or Campus.
No, actually, that is not my way. My way is that I buy 20 to 25 companies in the second group where I'm buying them a little early or sometimes when they might be expensive in somebody's view. But overall, I'm playing with 20 to 25 companies along these three themes, of which today I don't have one theme, which is IT. But otherwise, the three themes are financials, consumer, and IT, generally. And then you let the market decide or these companies decide how they evolve over time. It's not to say on any one name that this is the name we have found, but in the group of 25 names, mostly enough outperform to make the whole portfolio outperform. So play it like that instead of committing to any one name both your money and your ego beyond a point.
So that's the strategy that you're adopting. But let's also understand your view. I know we always have spoken about this, but maybe you want to revisit some other new age tech names in the portfolio now, given the kind of strategy that these companies are adopting. Do you think that this space deserves a relook?
Yeah, so we have two names in these 25 names, which are Paytm and Zomato. Paytm, of course, we have got good timing, so we are up some 20-25%. Zomato, we were up and then it went back, so now we are zero. But both these are big brands, big survivors. And although, like for example, you read recently that Reliance is coming into cosmetics or trying to compete with Nykaa and stuff like that, nobody is going to announce, new person is going to say that we are going into food delivery or going into even payment business so easily. And therefore these guys are now in a place where previously there may have been 20 guys and now they are, in the case of food delivery, down to 2, and there is no way a third guy can come in. And in this, one of the two is unlisted, and if they compete too hard and think that by getting a few more market share points here or there, they can have a hope of getting listed, that also does not work unless Zomato does well. So I think that the steady state solution will be that Swiggy will back off, let the Zomato win a little bit in the market so that some years or months later, maybe 1 year later, it can hope to go public. Otherwise, it can keep fighting without having ability to get listed, because the market will not accept a second name in exactly the same business with nearly exactly the same market share, with nearly exactly the same number of riders, with nearly exactly the same number of restaurant partners, and the first guy not doing well. It is just big picture in this case. But beyond that, it's an optionality, because the second business, which is Blinkit, also seems to be progressing well, and over time that would be worth a little bit on its own. Plus both these guys, that is Zomato and Paytm, have $1 billion cash kind of thing. So it's okay for now. It's both are optionality businesses, and so far so good.